How is everybody doing on this Saturday night, December 14th, 2024? You are in the strategy room with your host, Dr. Joe Berquist. As always, I've got a ton of banking related information and news that I'm going to be bringing to you tonight. So just hang on there and strap in for a ton of night of excitement and fun. Maybe not quite all that, but it'll be good. We're gonna learn a lot and go over a lot here tonight. So let's jump. I'll tell you what, we'll just jump right into a few things right here. We're going to start with obviously the big news of the week was inflation. We got more inflation data that came in, consumer price index. So I've got a couple articles here related to that we're going to run through here real quick. So consumer prices rose in November as inflation remains sticky. So the consumer price index rose 2.7% over the year. In November, up from 2.6% in October, marking the second consecutive month inflation has risen year over year. Groceries and used cars were among the items that got noticeably more expensive. The inflation rate was in line with expectations of forecasters, reinforcing expectations that the Federal Reserve will cut interest rates at its policy meeting next week. So consumer prices rose in November, with grocery prices showing their biggest increase in nearly 2 years as inflation continues to pressure household budgets. The consumer price index, like we said, was at 2.7%. The overall inflation number last month was in line with the expectations of forecasters. I love how they keep saying that the expectations are in line with forecasters. Not that inflation keeps ticking back up. It got back down to about 2.2%. And now it's gone back up to 2.3, 2.4, 2.5, 2.6, 2.7. And it's been steadily increasing every month. And like I said, it just gets I get kind of irritated with this whole notion of like, oh, well, it was in line with expectations. Yes, but it's not going back down to 2% anymore. It's not going back to where the Federal Reserve wants it to be. And like, in other words, the Federal Reserve's target rate is 2%. And preferably, they'd like to have it below 2%. If they could get it down to 1.5, 1.6, 1.7, somewhere in that neighborhood, that's an ideal situation for the Federal Reserve. So the two big takeaways from this are that, inflation's creeping back up. We are still getting pummeled in certain areas like food. Gas is maybe getting a little bit better, but food, auto insurance, a number of different sectors of the economy are just getting, just continue to see increases due to increasing inflation. And this is becoming a big problem. And this is going to dramatically slow the Fed down. And we're going to get to that, what the Fed is going to do. We're going to get to that in just a second. But here's an article from the Wall Street Journal. So this is strengthening inflation poses challenge for Trump and the Fed. Inflation ticks up to 2.7%, a sign that the path to bringing down price pressures remains bumpy. And see, we have a kind of a nice chart here, basically where we have core. And again, this is another key point. Core inflation is at 3.3%, much higher than the 2% target that the Fed wants it to be at. And we're seeing it. So again, it's not nearly as bad as it was about 2 years ago. It has come down, but the point is that it has now settled in comfortably. The overall has settled in comfortably well above the Fed's 2% target, and the core is way above the Fed's target, even well above 3%. And you're seeing that not only for the CPI, which we're talking about here, but you're also seeing that for the PPI and the PCE, which is, the PCE being the Fed's preferred index. So progress on bringing down inflation stalled in November, with the consumer price index of goods and service costs ticking up to 2.7% increase. Prices of consumer goods, everything's from cars to living room furniture, but excluding food and energy, increased at the fastest month-over-month pace in a year and a half, led by a jump in vehicle prices. That was partly because drivers replaced damaged cars and trucks after recent devastating hurricanes. The rise is notable because prices for many goods had generally been falling or flat for about a year through August. That trend appears to now be reversed. I would dispute that. The fact that they're saying that, all these prices and everything have been flat. No, they have definitely, absolutely, positively not been flat. They've been anything but flat. Have your prices, food prices, come down in the last couple? I asked that of everybody here. Have your food prices come down? Please let me know. I'd be interested to hear people's comments or their takes on this. And then the situation presents President-elect Donald Trump with a deep and central challenge as he prepares to take office with a promise to beat back inflation. Economists fear that goods inflation could accelerate if the incoming Trump administration follows through on their threat to impose the broad tariffs. Again, I talked about this a little bit last week. The whole tariffs argument is it's nonsense. First of all, most of the tariffs are just a threat. It's just a leverage. It's a leverage tactic in a negotiation situation. Most of these tariffs will never get put on. Are there going to be a couple situations where perhaps President Trump might actually hit a country, say China, with some sanctions or with some tariffs? Yes, I believe there probably will. Is it going to be to the extent that it's going to cause this massive spike in inflation? No, absolutely not. And you have to remember something. There are trade-offs. When we hit somebody with a tariff, that's going to cause good and bad on both sides and in invariably different ways. So yes, it might cause the price of something to go up. It might also cause something good to happen on another end of it. So it's not this, but they try to make the tariffs out to be like this boogeyman of like, oh, he's going to put tariffs on all these products and then they're all going to become more expensive and it's going to drive our inflation through the roof. No, that's not happening. The CPI report also raises questions for the Federal Reserve about the pace of rate cuts in the year ahead. And yes, this is going to be perhaps the most important thing. The Fed is widely expected to cut rates by a quarter point at its meeting next week, its third cut in a row. Investors in interest rates futures markets on Wednesday viewed a rate cut next week as a near certainty. A separate report on inflation due Thursday could help seal the case. And then they just have a chart here on wages and prices, changed from a year earlier, hourly earnings, weekly earnings, overall CPI. You can see hourly earnings and weekly earnings are up above, where the CPI is. Again, more inflationary pressures. Officials have indicated sticky inflation could lead them to slow the pace of rate reductions or stop altogether. Yes, I think that is a possibility. When you look at the Treasury rates right now, particularly the 10-year Treasury, as the 10-year Treasury it's come down just a hair. It's come down a little bit in the last week or so, but it's still hovering at that 4.25% range. And that has really had a muted effect on the Federal Reserve cutting interest rates. Now, do I think the Fed is going to cut the interest rate next week? Yes, I do. I do believe that they're going to, because again, you have to go back a couple months to what their original plan was. Their original plan was to cut 100 basis points this year. They were going to cut 100 basis points, and then they were going to take basically a pause in January and see what was happening. And I think they're going to stick right to that plan. The question then becomes next year. They had it slated to make a ton of more interest rate cuts next year, being much more aggressive. The real question becomes, are they going to continue that pace? I think that they are going to dramatically slow down because I think they're going to look at it. We are going to get some massive revisions to the labor market here. There was a lot of news, a lot of chatter that came out. I don't necessarily have a lot of stuff here tonight covering that aspect of it, but the Philly Federal Reserve just came out with some interesting news. Zero Hedge was also reporting on some things this week in a couple articles that they put out that basically the labor market is much, much worse than what we think it actually is. So you really have a poor labor market. You have a market where inflation is picking back up and where the Fed is cutting rates, yet the long-term treasuries continue to go up. And so you kind of look at that stew, if you will, and you sit there and you go, okay, the Fed is not going to continue cutting rates as they look at all this economic data and consider what's going on here. Now, I think what's going to happen is over the next 3 or 4 months, January, February, March, April, as we start to get the real employment numbers and as we start to get massive revisions on those employment numbers, and we see we actually get a very real perception of what the labor market actually looks like, which we really have not had for about 18 months. When we get that real picture, it's going to be a huge wake-up call to the markets, to a lot of people, and that's going to shift the situation, because once we see that deterioration in the labor market, then the Fed is going to be put in a really difficult spot, because it's going to be a choice of, do we lower interest rates to try to boost up economic growth, to try to boost up employment, or do we leave the interest rates high because we're worried about inflation, because we have to continue to fight inflation, and the longer term treasury yields are going up, so it's kind of it's negating the effect, if you will, of the interest rate cuts in the first place. So it's definitely going to be a very big balancing act. Now, I will also tell you this: there's a lot of people in the government, not just President Trump. There's going to be a lot of people in the government that are going to want the Federal Reserve to continue to reduce interest rates. Now, why is that? It's because of the national debt. We are currently paying over $1 trillion annually on the national debt. It is by far, it is larger than the defense budget. And we're paying that $1 trillion just to service the national debt. It is not paying down one dime, not one nickel of the national debt is getting paid down. That is over $1 trillion just to service the interest on that debt. Now, obviously, if you bring the interest rates down, that reduces the amount of money that the government has to spend on, to cover the national debt. That would help the government to a very real extent. So I think you're going to see a lot of pressure from politicians on the Fed this year to basically say, hey, listen, our national debt is out of control. We're trying to bring this thing down. But the main thing that we could do in the short term, 6 to 12 months, it would really help us out, would be if the Fed reduces the rates, and then that enables us to service the debt at a much cheaper cost. So like I said, but we're going to see how this plays out. It will get interesting. So let's and then so here we have an article that says Fed focus: easing core goods deflation, slow disinflation hinder the Fed's goals. So deflation of several key goods has started slowing in the U.S. economy, but disinflation for major services is moving at a crawl, making it hard for the Federal Reserve to achieve significant progress towards its target. The Consumer Price Index, the market's preferred measure of inflation, but not the Fed's. The Fed's is the PCE, increased more than 2.7% in the 12 months to November after rising 2.6% in October. It marks the highest yearly increase since July. The Bureau of Labor Statistics said in a December 11th report, the so-called core index, which removes volatile energy and food prices, increased 3.3%, the core, roughly where it has been since August. The Fed wants core inflation to make clear progress towards 2%, but little headway has been made in months. Like I said, it is settled into well over 2%. The lack of advancement toward this goal comes at a particularly thorny time as the Fed looks to scale back expectations for interest rate cuts in 2025, and President-elect Donald Trump looks to launch tariff and immigration initiatives viewed as inflationary and potentially counter to the central bank's monetary policy efforts. It remains unclear if or when this trend in price movement may shift, as consumer demand has remained strong, seemingly despite borrowing rates being near their highest level in decades, and some of the stickiest sectors in the inflation data have shown little signs of becoming unstuck. We're in a period of steady inflation with the potential to go either way, said David Russell, global head of market strategy at TradeStation. A chief issue has been deflation among core goods, such as household furnishings, apparel, and other goods, where prices fell 1.7% year over year during each month from May through August. That slowed to negative 1.2% in September and negative 0.7% in November. Goods deflation is petering out as the price relief from improved supply chains and the drop in commodity prices from 2022 highs have already filtered through to inflation, said Sarah House, a senior economist with Wells Fargo. I don't think we'll see the degree of goods deflation we saw this summer return as supply chain pressures have neutralized. Businesses are satisfied with their inventory levels. Demand is not collapsing and higher tariffs loom. And let's see here. And then what does it say here? And then it says, in addition, inflation among core services remains at 4.6% annually and has averaged about 4.8% over the past 4 months after falling from a peak 7.3% in February 2023 to 5.3% in December 2023. Core services inflation has fallen to 4.6% from 5.2% over the same period in 2024. One of those core services, shelter, makes up 37% of the consumer price index and remains the single most important item in inflation. With shelter, the measures of rent of primary residence and owners' equivalent rent of residence fell to their lowest levels since the spring of 2022, but the decline has slowed. So in other words, shelter, that's the cost you're paying to keep a roof over your head. So the cost of, getting a new mortgage has gone up. The cost of rent, as we all know, has skyrocketed. So that is making up the biggest part of the inflation. Now, I wanted everybody to think about something here. So core services, what does that really mean? What are core services and why are they so? Core services are at 4.6% annually right now, and they have been at an average of 4.8%. That's extremely higher than the CPI is at 2.7%, with the core CPI at 3.3%, but the core services remains at 4.6. That is a huge difference there. But what are core services? Think about it. When you go to a lawyer and you ask a lawyer to hey, do some services for me, their bills are going up at 4.6%. You go into the accountant, you say, hey, Mr. Accountant, I'd like you to do my tax returns for me. No problem. It'll be an increase of 4.6%. And that's across the board. I mean, it's like car insurance. Again, your core services. So any type of service billing, you go to your roofer, you go to your plumber, you go to your electrician. All their prices are higher for performing these core services. Okay, so this kind of leads us to our next topic now. So Trump just said he won't replace Fed Chair Powell. So what's next? So President-elect Donald Trump, in a weekend interview, said he won't replace Federal Reserve Chairman Jeremy Powell. Powell, meanwhile, has said he would not step down if the future president asks. Investor eyes are fixed on the relationship between the men and the shape of possible future appointments and policy moves. So President-elect Donald Trump said he won't replace Fed Chair Jeremy Powell, but that may not keep them off the collision course they seem on. In an interview aired on Sunday, NBC's Meet the Press, Trump said he would not replace Powell, whom he appointed in 2017. Now, remember, Powell only has 2 years remaining on his term. His term is going to be up in 2026. So, so President Trump, he might be of the opinion of, hey, I'll try to work with this guy as much as I can over the next 2 years. But if this guy really gives me a problem, so what? He's only going to be there for 2 years, and then I can give him the boot and I can bring in who I want. So, but in the meantime, can Jeremy Powell, cause some issues? He can. I think the mistake that Jeremy Powell is making is that, traditionally the press and everyone has always been on the side of the Federal Reserve. I don't think that is the case anymore. I think that you definitely have a healthy amount of skepticism out there about the Fed and the things that the Fed has done. If anybody has ever watched my the Lords of Easy Money series that I did, I would highly recommend everybody check that out if you want to see the massive amount of collateral damage that the Fed has caused for the last 16 years. And I always go back to this notion of, Ben Bernanke, Janet Yellen, and Federal Reserve Jeremy Powell. I call them the three amigos. The three amigos, their legacies are all tied together because it has been them that have driven this whole strategy since 2008. And every one of them, they're thick as thieves, and all three of them have had this kind of weird relationship where each one is determined to carry out and kind of continue on the legacy of what the last one did, no matter what. And they keep going it. And they have done, in certain respects, irreparable damage to the economy. And again, most people don't see that unless you really understand the world of economics and finance and the financial markets. It's really hard to understand that. And that's what prompted me. That's why I did the whole series on the Lords of Easy Money, because I wanted people, that book, it's based on the book, and that whole series, there's so much in there. There's so much packed into that I couldn't possibly go over that in a 1 hour live stream. I couldn't possibly cover it in just a couple of short episodes. I had to do this entire episode series. I had to go chapter by chapter and break it all down. But if you really want to understand what's going on in the economy, what the Fed has done for the last 15, 16 years, why Jeremy Powell has caused a lot of problems with the market, you have to go back and read that book and understand that. There's another book called Trillion Dollar Triage, which was another great book, which I have to get, which was that was written by the Wall Street, the fabulous, really good Wall Street Journal reporter, Nicholas Tamos. I think I'm saying his last name wrong, but it'll come back to me. But he did a very good book as well, and I'm gonna cover that one in the new year, because they kind of go hand in hand together in a certain respect. But okay, so Trump says he's not going to replace Powell, and then we have another article here which basically says Trump's Fed appointments could shift monetary policy, but maybe not right away. So President-elect Donald Trump has said he wants more influence over Federal Reserve policy, but indicated this weekend that he won't ask Federal Reserve Chair Jeremy Powell to step down. Trump could, however, shape monetary policy through appointments to the Federal Reserve Board of Governors. Trump may have to wait until 2026 before he can make changes to the Federal Reserve Board, where he would have an opportunity to appoint a new governor in January and a new chair in May of that year. President-elect Donald Trump has expressed a desire for more control over monetary policy. Getting there could take a while. I don't necessarily agree with that. I don't think that Trump has expressed this great desire to like totally control monetary policy. I just think from his perspective, if he's talking with like all of his economic advisors, if he's talking with the people at the Fed and everybody agrees that the interest rates need to come down, and that's the best thing and the best course of action for the country as a whole, I think he just wants to be able to turn to the chairman of the Fed and basically say, okay, we've talked to all the experts and everybody's saying that rates have to come down, so go do it. And then he expects the Fed to follow through with that plan. I think that, but this idea that he just wants to arbitrarily, say or do things and just have the Fed, just do that. I think that's over the top, so to speak. I don't really think that that's really what's going on there. I think that the press in certain respects kind of blows that out of proportion. The president has a million. I think we all have to remember the president has a million things going on all day, every day. It is a very, very difficult job. There's a lot of things going on. And the president doesn't have time to be doing monetary policy all day, every day. That's the Fed's job. That's what they do. And I don't think the president has any, I don't think the president has any issue with leaving that to the Fed to do what they do. But I would caution the Fed. Here's where I would caution the Fed. And just what I said a few minutes ago, Jeremy Powell, I think, is making a big mistake in the sense that I think he believes that like, hey, everybody is still on our side. And I don't think that's the case anymore. I don't think that everybody is on the Fed's side. And I would caution him in the sense that there's probably a bigger group of people in the Congress right now that would be open, not necessarily to the argument of end the Fed, but would they be open to the argument of let's neuter the Fed, or let's dramatically change how the Fed works, or let's maybe maybe Trump can't fire the chairman of the Fed right now, but maybe we're going to change that. Maybe we're going to change that law. Maybe we're going to change a lot of things. Maybe we're going to give the president more power over the Federal Reserve in the future. Maybe we're going to give the Congress and the Senate more power over the Fed in the future. Maybe we're going to demand an audit of the Fed every year. They're going to have to audit their books and show us what's going on. I think there's a lot of things that could happen to the Fed if Jeremy Powell basically is not careful by the way he navigates this. I think if he comes out and just wants to be like a bull in a china shop and is just going to push back on everything that Trump or Trump's administration either wants to do or is asking him to do, I think he's gonna wake up one day and he's gonna dramatically regret going down that path. So, all right, so let's get off of that topic for a few minutes. So one other thing, here's another story I wanted to cover this week, and I'm going to cover this, and then I'm going to go into a couple other things I'd like to cover. I want to talk about the economic indicators that are coming up this week. I want to talk about some of the episodes I just put out over the last week too. So this was a big story this week. So basically Albertsons sues Kroger and terminates the merger after the judge blocks the supermarket mega deal. So Albertsons accused rival of not doing enough to win approval for the $20 billion deal. Kroger says the claims are baseless. So America's two biggest supermarket operators have gone from deal partners to legal rivals in less than 24 hours. Grocery store operator Albertson said it terminated its planned sale to Kroger and filed a lawsuit alleging that Kroger didn't do enough to secure regulatory approval for the company's $20 billion deal a day after a federal court blocked it. Rather than fulfilling its contractual obligations to ensure that the merger succeeded, Kroger acted in its own financial self-interest, repeatedly providing insufficient divestiture proposals that ignored regulators' concerns. Tom Moriarty, Albertsons general counsel, said Wednesday. The company's lawsuit, filed in a Delaware Chancery Court, seeks billions of dollars in damages from Kroger. A Kroger spokeswoman said that the Albertsons claims are baseless and without merit, and that Kroger is evaluating its options. Kroger said that Albertsons repeatedly breached the merger agreement during the legal process and that the suit is an attempt to deflect responsibility and to seek repayment of the merger's breakup fee, to which Kroger said Albertsons isn't entitled. Kroger in October 2022 unveiled its deal to acquire Albertsons, seeking to create a bigger supermarket operator better equipped to compete against mega retailers such as Walmart and Amazon. The Federal Trade Commission sued earlier this year to block the deal, alleging it would reduce competition and lead to higher grocery prices for consumers. And then on Tuesday, U.S. District Judge Adrian Nelson ruled against the deal, siding with the FTC's argument that absorbing Albertsons' nearly 2,000 stores would leave Kroger overly dominant in the traditional grocery store space. As a result, Albertsons shares fell 1.5% Wednesday, while Kroger shares gained 1%. So this was a huge merger that really would have changed the landscape in the food industry. And would it have driven up prices for consumers? I don't know. I don't know if that really would have happened. But I do think that what would have happened is that some grocery stores are in some of the different areas that were controlled here between these two big behemoths definitely would have gone by the wayside. I mean, you definitely would have lost some food stores, and there is a possibility, there's this concept of food desert. And what a food desert is, that's an area, either it could be in a city, could be out in the suburbs or a very rural area where basically you just don't have a food store. And if there's no food store in the area, they call that a food desert. And could this have created a situation where some of their less performing stores in smaller areas or maybe some rougher areas of some of the cities that they're in where they maybe close some things? I think it probably would have. And I think that was probably what a lot of these judges were looking at. I mean, they use the excuse of saying, oh, well, this would have, they would have increased prices. It would have hurt consumers. I mean, which is not, I don't think, totally untrue. But I think the bigger issue is that with this merger would have undoubtedly come some store closings, some loss of employees, and it would, so it would have, I think it would have hurt some areas, and I think that was probably a big, reason or big consideration of the judge, if you will, in this case. So, okay, well, we're going to get into some other bank news. I got some TD stuff here. TD's incoming CEO says everything is on the table as the U.S. asset cap looms. But we'll get back into that in just a second. So first thing I wanted to do. So what do we got coming up this week? We got a lot of economic data coming out this week. Monday, December 16th, we have the New York Empire State Manufacturing Index. We have manufacturing PMI and services PMI again coming out on Monday. On Tuesday, December 17th, we got retail sales, industrial production, the 20-year bond auction, and we got the API weekly crude oil stock. On Wednesday, we get building permits, housing starts, the FOMC economic projections at 2 o'clock, FOMC statement at 2 o'clock, the Fed interest rate decision at 2 o'clock, and then the FOMC press conference following that at 2:30. On Thursday, December 19th, we get continuing jobless claims, GDP. We get the initial jobless claims, and we get the Philadelphia Fed Manufacturing Index. And then finally, on Friday, December 20th, we get the core PCE price index. We get personal spending. We get the Michigan consumer sentiment. And then we also get the U.S. Baker Hughes total rig count. So huge week this week. I mean, we got retail sales on Tuesday. We got some manufacturing data. We got the major day on Wednesday with the Fed making their announcement, what most people believe will be another 25 basis point rate cut on Wednesday. On Thursday, we're going to get more GDP numbers. We're going to get, Philly Fed with some more manufacturing numbers. And then Friday, we're getting that core PCE price index number, more inflationary number. My bet is you'll probably see retail sales go up again. GDP will probably remain somewhere steady, somewhere in the area that we've seen. I think the GDP numbers are bogus, but again, that's another thing that we'll see. I believe my prediction is we're going to see a dramatic adjustment in GDP come first and second quarters next year. But we got just a ton of information coming up. Now, I would preface this by saying, after this week, the next 2 weeks are going to be pretty quiet because you got Christmas the next week, and then you've got New Year's the week after, both coming on Wednesdays in those weeks. So I think both of those weeks will be relatively quiet with the economic data, economic information that's coming out. And so this week's going to be a huge week, and then we'll have to wait for basically that first week in January before I think we pick back up with a lot more economic data for the month of December. And then, we'll go from there and see what happens. But, okay. Hang on. Need some water for just a second. All right. So I want to talk for just 5 minutes here. I just want to talk about the episodes that I had that came out this week. So I released 5 episodes this week, Monday through Friday, it's kind of my usual production schedule, if you will, that I've had come out. I've been kind of going with this for the last couple of months. I kind of feel like this has been a good kind of rhythm here for the channel. So, but on Monday, I had episode 277, which was called "Is AI Risk Keeping Board Members Up at Night?" And I actually thought that was a really interesting episode. It was based on an article in the Wall Street Journal that talked about how are board members, so in other words, at the board level, how are they dealing with AI? How do they perceive AI in terms of risk, reward, pros and cons? And I just thought it was a really interesting concept to kind of look at what are, how are board members feeling about AI, and what kind of concerns do they really have at the moment? And again, I thought it was good because a lot of the conversation around AI right now, it's all really based around the technology itself, or it may reduce jobs. But we haven't really had a conversation around, board members' overall thoughts. Are board members really concerned with this? So again, check that episode out if you're curious about that. Then on Tuesday, I had episode 278, which was rest in peace, Bernard Marcus, who was the co-founder of Home Depot. I thought Bernard had an amazing career. Just did some incredible things with being one of the co-founders of Home Depot. So I kind of talk about Bertie's career a little bit in that episode. I just talk about some of the more interesting things that went on there at Home Depot. Told you about the book that he wrote, and so definitely go check that out when you have a second. On Wednesday, I did episode 279, which was Student Borrowers Have Problems. And I basically covered two recent reports that came out from the Consumer Financial Protection Bureau. One of them was on student loan servicers. What are the issues that borrowers are having right now with the student loan servicers? And then the other report was basically student loan borrowers themselves. What are the issues that student borrowers are dealing with? And so, I went through those two reports, kind of covered those things. On Thursday, we had episode 280, which was the Trump effect on crypto, which I that was kept the crypto series going. That was crypto series now part 13. And I basically talked about how, President Trump coming in has caused Bitcoin to jump up to over 100,000. There's all this optimism now around the crypto market, the crypto ecosystem, if you will. And we talked about a little bit about the history and the price movements of Bitcoin, how it's gone up since, 2009, and kind of some of the ups and downs that it's had. And we looked at Coinbase. We looked at a couple different things there. So I think that was, again, pretty interesting episode. If you're interested in the crypto space, definitely go check that out. And then finally on Friday, I had episode 281, which was called Is Fair Isaac's Competitive Advantage in Trouble? Now, for anybody that doesn't know, Fair Isaac is the company that generates what's called the FICO score, and that is the key score that is used in all the credit reports. So if you go to TransUnion, Equifax, Experian, and you go in to basically pull a credit report, they use the FICO credit scoring model to generate your credit report. And so what the article there, and again, that was also based on a Wall Street Journal article, and what that article talked about was that how Fair Isaac, like several other companies out there, is basically like a kind of like a data analytics, data broker in a certain regard. But that basically the other companies had kind of diversified their revenue streams, and they had different product lines, different business lines, different things that they could rely on. So if kind of their main moneymaker got disrupted for some reason, it wouldn't be the end of the world. However, with Fair Isaac, they continue to just kind of lean on this FICO model, and as I reported on in another episode a few months back, one of the things that the regulators are trying to change right now in the residential mortgage space is that they want to go to a different FICO scoring model, and they also want to bring in a secondary model called the Vantage Score model. And so the question then becomes, if the regulators want to start to move away from the classic FICO credit scoring model, where does that leave Fair Isaac? Now, it's not going to put them out of business. It's not going to it's not going to, kill them, but it could have a dramatic impact on their company, and it could take away, I don't want to say that they have like a monopoly right now, but they're pretty dominant in that space. Granted that their FICO scoring model is the prominent model right now and has been for a long time for generating your credit reports. And if that model isn't used or it gets disrupted and there's another model that comes in that takes away a big chunk of that business, what does that do to Fair Isaac? Does that, again, the obvious question, does it hurt their ongoing competitive advantage? So like I said, if you find any of that stuff interesting, go check that out. This week and next week, I will have episodes coming out. I'll tell everybody now. I should have another 5 episodes this week, again, Monday through Friday. The following week, Christmas week, I will have 5 episodes coming out that week. But I will not. There will be a live stream next weekend on the 21st. But I will not have a live stream the next weekend. That weekend after, I think that'll be that might be. That'll be December 28th. So December 28th, I won't have a live stream that weekend because I'll be doing some stuff for the Christmas holiday. But there will be episodes coming out all that week. I just won't have a live stream. And then the that week of New Year's week, I haven't quite figured that out yet. That weekend, I will have some stuff out eventually that week, but the first couple days that week, I might not. Monday, Tuesday, I might not have anything. But I'll kind of see what happens. But like I said, this week, 5 more episodes will be coming out this week. Hopefully a lot of great reports and other things that came out, and hopefully some good stuff that people will enjoy if you're liking some of the other content I'm putting out on the channel. So, okay, anyway, let's get back to some of these articles here. We're going to look in, like I said, back to TD Bank here. So TD Bank, so for those that don't know, Wells Fargo has an asset cap right now, and they're under this asset cap, which is really restricting their growth. And the regulators kind of liked this penalty, if you will, and they found that the asset cap idea has worked, and it is actually proved kind of very effective, if you will, in holding Wells Fargo in line. So now here comes victim number 2, TD Bank, who was nailed with a massive, violations of anti-money laundering and BSA. And they got hit with a $3 billion fine, one of the largest fines ever. And has led to some turnover at the company. Obviously, new CEO coming in. A bunch of other people have been kind of let go or shuffled around, what have you. And so now they get to tackle this whole idea of the asset cap. They're trying to figure out what to do with the asset cap. So let's kind of jump into this article here for a second. So this says the incoming CEO of TD Bank Group, the Toronto-based parent company of Cherry Hills TD Bank, said the company is undertaking a broad and detailed review of its strategies and investment priorities after the imposition of a federal asset cap and more than $3 billion in fines to settle charges that it failed to effectively control U.S. money laundering. Raymond Chun, who will replace the retiring Bharat Masrani as CEO in April, said Thursday he is looking at the bank's business mix, including profitability and risk-adjusted return on capital, and where it needs to invest and divest to improve. Everything is on the table, Chun told analysts during the bank's fourth quarter earnings call. When asked if the review will include potential U.S. asset sales, he promised to provide an update when the company holds an investor day in the second half of its fiscal year 2025 while it conducts the review. TD suspended its medium-term financial targets and guidance, including earnings per share growth, return on equity, and positive operating leverage. What do you think that did to its stock price? Let's see here. TD stock price was down more than 5% to 55.53 in mid-afternoon trading Thursday. The stock closed at 62.77 on October 9th, the day before the bank's settlement with the U.S. government was announced. So, so that is obviously anytime any bank or any financial institution comes out and basically says that they are going to suspend their medium-term financial targets and guidance, including earnings per share growth, return on equity, and positive operating leverage, their stock is going to get brutalized. It's going to get hammered. And that's exactly what's happening here at TD Bank. And then it just goes on to say that, TD Bank is the second largest bank in the Philadelphia region. They pleaded guilty to these charges. They're working on fixing the issues, yada, yada, yada. So what they're talking about there, again, going back here to kind of the beginning, when they basically asked them, they said, hey, I lost that spot there. What did it say there? So basically on Thursday, when he was basically asked at looking at the bank's business mix, including profitability and risk-adjusted return on capital, and where it needs to invest and divest to make improvements, and they basically asked, will it review include any potential U.S. asset sales? So what does that mean? Well, that means banks. That means business lines here in the U.S., whether it would be like wealth management or insurance, or maybe what else am I thinking? Maybe like a leasing division, something along those lines. So this is definitely going to cause some of that to happen. TD Bank is basically going to be, they're going to be cutting some things here over the next year or two to try to stay in line, because if they don't do that, they're not going to be able to say they want to grow loans. They have to now make a trade-off in order to accomplish that. They're going to have to sell some assets to create some room on the balance sheet to be able to grow their lending, while not exceeding that new asset cap. So if that makes sense to people out there, how that's going to work. So like I said, we will keep an eye on this one and monitor it, but I'm sure it is not going to be, the next few years are not going to be fun years for TD Bank. Okay, the IRS is again delaying a small business tax reporting requirement. So this was an interesting one. So the IRS has delayed a requirement that business owners and freelancers report more than $600 in income from platforms such as PayPal and Venmo. The agency, in a recent notice, said it will instead phase in that reporting requirement over the next few years. Taxpayers will be required to report total income of more than $5,000 for the 2024 tax year, more than $2,500 for the 2025 tax year, and finally more than $600 for 2026. Meanwhile, the IRS will not penalize anyone for failure to withhold or pay backup tax during the 2024 calendar year, but will do so for 2025 and onward, the agency said. So this is not the first time the IRS has delayed the reporting requirement, having done so in 2022 and then again in 2023 after a barrage of criticism regarding the move. Well, I wouldn't be shocked. There's this kind of new administration coming in here in about 40 days. And yeah, I wouldn't be surprised if this thing just, gets the heave ho altogether, because I think it's pretty stupid. But we shall see. But I think that's good news. It's good news for the moment. I think that helps people out, at least in the short term. So that's a good thing. Okay, U.S. office market vacancy rate dips, and 2025 could be volatile. Now, I had some notes on this one. All right, I can't find that at this second, so we'll just run through it. But basically, this says the U.S. office vacancy rate has begun to stabilize and dip ever so slightly, according to some industry trackers, but it's still not likely to hit bottom for another several quarters. The nation's office vacancy rate declined to 20% in the third quarter, down just barely from the 20.1% the previous quarter, according to Moody's Analytics. While the quarterly decline may be a positive indicator for the market, the national vacancy rate is predicted by the firm to move up and down more before settling into a new normal. More precisely, Moody's is forecasting the national office market won't hit bottom on a vacancy basis until late 2025 or early 2026. Matt Reddy, Director of Commercial Real Estate Economics at Moody's, said office vacancy tends to move more slowly than other market metrics because of how long most office leases are, 10 years or more years in many cases. That means a significant share of leases haven't matured since the COVID-19 pandemic upended the office market. We're still seeing some companies just now getting their first lease rollover since the pandemic and turning some of that space back over, meaning that they want to go to smaller spaces. And while the vacancy rate could rise in the coming quarters, there are a number of counterbalancing forces to help keep the rate from growing too much, Reddy said. That includes a slowdown in new office construction, which is likely to continue next year, as well as gains in office using employment. The third quarter saw a dip in the office vacancy nationally because net absorption turned positive, with more than 5 million square feet of absorption tracked by Moody's after 7 consecutive quarters of decline. Speculation has been rampant about whether more return to office efforts in 2025, fueled by Amazon Inc. CEO Andy Jassy's announcement this fall that the tech giant's employees would be required in the office 5 days a week starting in January, will turn into more space demand. But it's tough to say beyond a few headline-grabbing moves whether many more companies will be going back to the office more days per week in 2025. If people will recall, one of the biggest culprits of the remote working has been the United States government. And again, with the new administration coming in, I have a feeling a lot of those workers are going to be coming back to the offices very shortly. I also think that some of that vacant office space that the government is using is going to get dumped. They're going to dump that office space off. They're going to sell it, and they're going to try to recoup that money and hopefully use that money in better ways. Again, one can dream that the government would actually do what they're supposed to do. Okay, here's an interesting one. SBA writes off billions more in COVID-era small business loans. As anybody knows that has been following the channel, I've done multiple episodes on this, the challenges that the SBA has had with basically COVID, their EIDL loans, as it were. So the Small Business Administration has again written off billions of dollars in COVID-era small business loans. The two newly issued reports say the agency doesn't have the necessary system in place to keep track of which loans are eligible for its hardship programs. New data from the agency shows the SBA charged off about $18.6 billion in COVID economic injury disaster loan programs, loan program loans in fiscal 2024, which ended September 30th. That represents about 6.5% of the total portfolio the agency is still servicing, which was roughly 2.3 million loans valued at $287 billion as of October 15th. The agency charges off a loan when it believes it will be unable to collect on it, essentially removing it from its books. It can, however, still attempt to collect on the loans or send it to the Treasury Department for its own collection efforts. The SBA ultimately approved about 4.1 million loans for roughly $390 billion through the EIDL loan program, but that amount has dropped as some approved loans were quickly returned and others were paid off. But as we can see here, the loan volume charged off by the SBA in fiscal 2024 is down from the nearly $52 billion it charged off in COVID loans in fiscal 2023, a sum that represented 17.2% of their total portfolio at the time. So again, we've got 18.6 billion and then 52 billion. So they've basically written off over $70 billion worth of these EIDL loans in just the last 2 years. That is a staggering amount. That is 23, almost 24% of the total portfolio they have written off. I mean, this has been, beyond a disaster. And then here's what I really wanted to point out. So this is the last part of the article, which it says, audit spotlights SBA monitoring of the loans. Now, this is a barn burner here, so get ready for this. Information on charge-offs in the COVID EIDL program add to questions about that portfolio of loans for the SBA overall. A new report by the SBA's Office of Inspector General found that when the SBA expanded its hardship accommodation program to help COVID EIDL borrowers avoid default, it was unable to continue monitoring those loans to ensure they remained eligible. Management did not design and implement effective controls over the review of reinstated loans resulting from HAP enrollments, the IG report said. The COVID-19 EIDLs that were reinstated due to HAP enrollments were not subsequently monitored to ensure those loans continued to meet the HAP eligibility. That lack of monitoring was also noted through an audit of the SBA by accounting firm KPMG, which found there were 7 areas with what it called material weaknesses and 2 significant deficiencies in which it was unable to obtain sufficient and appropriate audit evidence. These control deficiencies contributed to the SBA's inability to provide relevant and reliable information to support a significant number of transactions and account balances related to these programs, KPMG said in an audit letter included in the SBA's IG report. KMG found the SBA did not design and implement adequate monitoring controls over its loan portfolio to ensure reliable financial reporting, and that it was not designed to identify a complete and accurate population of outstanding loans. Furthermore, management did not identify and research COVID-19 EIDLs with unresolved hold codes for loans charged off in deferment, repayment, and delinquent stages as of the end of the fiscal year. In addition, management did not consistently reinstate loans receivable for COVID-19 EIDLs that were enrolled in a HAP, which were previously charged off, and in certain instances, the borrowers were making payments. That's pretty damning, folks. That's pretty damning. That is just wow. That's wow. So let me put it to you this way. So the SBA the SBA actually has been a great department of the government for many, many decades. They've done a very good job there. But I want you to think of the SBA as basically like an insurance company. Okay, the SBA does not do direct lending, and this whole EIDL fiasco is a perfect example of why the SBA does not do direct lending. What the SBA does is the bank is always the direct lender. The bank makes the loan to the borrower. What the SBA does is they provide a guarantee on that loan to the bank. And that basically helps the bank kind of get over the hump, so to speak, because what you usually have with SBA loans is it's either a startup business, it's a business that has a total lack of collateral. There may be no collateral there to do the loan. They may have to rely on projected income, projected revenues, in which case the bank might be saying, we don't know if we want to do this. It might be a little bit too much. But if we get an SBA guarantee on it, then it gets the bank comfortable enough to say yes on the loan. So again, the SBA is not a direct lender. They just provide a guarantee on the loans. Now, is it a full guarantee? No, it is not. It does not guarantee 100% of the loan. Usually it guarantees 75 to 85% of the loan, depending on the SBA program that you're using or the SBA loan type that you're dealing with. Now, why am I going into all this? Why am I talking to all this at length? I'm talking about all this because if the shoe here was on the other foot, if this was a bank that did this and the SBA was reviewing that bank's SBA loan portfolio and they got this report from the bank's accountant and this report from, say, the FDIC, that bank would be in a world of hurt. It would be in a world of hurt. SBA would be going in, basically pulling everything, saying this bank is done. We want full reviews. We want this bank to be closed. Like it would be big problems for that bank or that financial institution. But here, the SBA has it, and so far there hasn't really been much accountability of it. It's like, hey, you guys made all these loans, and it's worse than a disaster. It's a catastrophe. And like I said, so this story, I find it fascinating because it just seems to keep getting worse and worse and worse and worse. So so we'll continue to keep an eye on this, but my guess is there's going to be a new head to the SBA very shortly. Again, in just 40 days, we're going to have a new head of the SBA. My guess is you're going to see a lot of changes over there at the SBA. You're going to see a lot of changes, and I think it will be for the good. I think it'll be a lot of things for the good. So, this was an interesting article this week. Walgreens is in talks to sell itself to private equity firm Sycamore Partners. The deal would cap a tumultuous run for retailers whose market value shrank from a peak of over $100 billion to below $8 billion. So, if anybody remembers, I did an episode, which is, I think it was called, basically what's going on with like Walgreens, CVS, Rite Aid. Anybody that's been following that story throughout this year knows that basically, every one of them has come out and it basically has been closing stores. CVS has closed, hundreds of stores over the last 2 years. Rite Aid just filed for bankruptcy, closed a ton of stores. I think they're getting ready to come out of their bankruptcy now with probably about 1,300 stores left in the U.S., but nothing compared to their peak. And now Walgreens is now. When Walgreens says that they want to sell, that what they're really selling is basically the retail portion, the retail stores. And so, and in the episode that I did, I really got in depth about all this, and I talked about how Obamacare. Basically, when we got Obamacare back in 2010, it over the course of the next 5-6 years, it basically killed all the mom and pop pharmacies. Not 100%, but it killed 95% of them. And it forced all that pharmacy business into Walgreens, CVS, and Rite Aid. And we were told that, oh, hey, this is all for the best because we're going to we'll get economies of scale and, it'll be better for the consumer and all this stuff or whatever. And now, basically these three guys, Rite Aid, CVS, and Walgreens, they're basically losing their butts now. And this business is collapsing in. So the question that I asked was, okay, if these three businesses go out, what is going to happen then? Where does that leave us for consumers, for people that need to get their prescriptions filled, all this kind of stuff? Well, all of this is going to get pushed back into basically the hands of, like, say, Walmart and Amazon. So you're going to be going to Walmart all the time, or you're going to be ordering over Amazon to fill your prescriptions. That's where this could be heading. Now, do I think that this is a major problem? I think this is a huge problem. And I think that this is something that is going to have to be tackled with. But like I said, let's just go through this story very quickly here. So again, Walgreens is in talk to sell to this private equity. So Walgreens is in talks to sell itself to a private equity firm in a deal that would take the pharmacy chain off the public market after its shares have been on a downside slide for nearly a decade. Walgreens, Boots Alliance, and Sycamore Partners have been discussing a deal that could be completed early next year, assuming talks don't fall apart, according to people familiar with the matter. Walgreens' market value reached a peak of over $100 billion in 2015, but had since shrunk to around $7.5 billion as of Monday. Now, again, why did that happen? It happened because of what I said. In 2015, they hit their high. Why is that? Because Obamacare kicked in and it killed all the mom and pop pharmacies. So these guys saw a huge uptick in business, and they said, oh, hey, we got to grow. We got to build some more stores and everything. If people are familiar with like the commercial real estate market back then, they were trying to put, between the three of them, between Rite Aid, CVS, and Walgreens, back in those days, they were trying to put a new pharmacy with a drive-through on like every corner they could possibly get their hands on all over the U.S. But now that has, like I said, but that has now changed as the economic realities have now hit. All the mom and pops are gone. It's just these three guys, and these three have been, beating each other over the head, competing. And Rite Aid has gotten kind of the worst end of that stick so far, but CVS and Walgreens have still felt it. But that's why you're seeing that this market value shrink down. So mounting pressures on both its pharmacy and retail businesses has helped send its shares down nearly 70% so far this year. Before the Wall Street Journal reported on the deal talks on Tuesday, Walgreens shares closed up 18% Tuesday after the report, marking the highest one-day jump in the company's history and giving it a market value of around $9 billion. Any deal would be a big bite for Sycamore, a New York-based firm that specializes in retail and consumer investments and more recently is better known for smaller deals. The firm would likely sell off pieces of the business or work with partners, one of the people said. Walgreens spent more than 12 decades scaling to become one of America's most ubiquitous retailers, with its stores cementing themselves as neighborhood staples. Today, it operates over 12,000 stores across the U.S., Latin America, and Europe, according to its website. The company also invested significantly in healthcare clinics in recent years. And it goes on to talk about, rocky acquisition, the private equity interest. So the company has long been seen as a potential private equity target, though for many years its size seemed to put it out of reach. Private equity firm KKR made a roughly $70 billion offer for the company in 2019. Bloomberg and the Financial Times reported at the time. A KKR spokeswoman said the firm never made a binding offer for Walgreens. The market value of Walgreens was less than $50 billion, which would have made it one of the largest take-private transactions ever. So private equity appetite for buying retailers has waned since high-profile flops, including Toys R Us, Bain Capital, Mitt Romney. Thank you for destroying Toys R Us. If anybody doesn't know that story, that's a good one. That's a good one. I'll save that for another time. Made financing such transactions much more difficult. In the past few years, only a handful of sizable retailers have been sold to private equity firms, though many have attracted takeover interest. One of Sycamore's last major deals was when it bought office retailer Staples for almost $7 billion in 2017. It was among the suitors for Kohl's in 2022. In September, Sycamore announced a small deal for the restaurant chain Playa Bowls. Okay, so we'll keep an eye on that one. And then, so here we go. So why small business lending may see light at the end of the tunnel in 2025. So the Federal Reserve may be cutting rates more, while some small business owners have continued to struggle. What I wanted to get to at the bottom here is it said, so what should small business owners do to prepare for securing financing in 2025? And I thought this was good. They should get their house in order. Preparation is key for small business owners looking to secure financing. That includes ensuring their financial statements are up to date, accurate, and reflect a clear understanding of their business operations, crafting a detailed and well-supported plan for how the business would use the funds. That includes the projected return on investment, whether it's in potential revenue growth or operational deficiencies. Prioritizing building relationships with their lenders. Yes, absolutely. That includes making sure there is open communication and demonstrating a track record of reliability, which can significantly enhance loan approval prospects. Exploring all options, whether it's traditional bank loans, SBA loans, or specialized industry-specific funding programs. Maintaining liquidity and reducing existing liabilities where possible to help improve the overall financial health of a business and make it more attractive to lenders. And then it says, meanwhile, the SBA itself may be subject to additional scrutiny in 2025. Yes, after what we just talked about, yeah, I would say, yeah, that is almost assured. But again, so I thought some really good tips here. Ensure your financial statements are up to date. Now, what does it mean by financial statements? It could mean like QuickBooks. Most companies out there use QuickBooks. Just make sure your QuickBooks are up to date. So that way, if you went in to apply for a loan and the bank asked you for some year-to-date reports, like they want a year-to-date profit and loss statement, a year-to-date balance sheet, maybe they need an accounts receivable, an inventory listing, a work in progress report, that kind of thing. Depending on what your company does, how they do it, that's always really good to have, that information on hand. Crafting a detailed and well-supported plan for how the business would use the funds. I think that really depends on the situation. Like if you're a new business or a newer business, like maybe you've only been in operation for 2 or 3 years. Yeah, that could probably come in handy for, really showing a banker that you've really thought through like what you're going to do with the money, exactly how you're going to deploy it, how you're going to use it to increase revenues and thus hopefully increase the bottom line of the company. Are you going to use that money to expand into a new business line? Are you going to use that money to hire more employees? Are you going to use that money to beef up your vehicles? Are you going to move it, or use it to buy inventory? How exactly are you using that? What are you going to do with it? And what are you hoping it's going to achieve for your business? Again, prioritizing the business relationship with the lender. Yeah, I think that is extremely important. I think you absolutely want to always do that. And then exploring all options. Are you looking for a traditional bank loan? Do you need SBA financing? Do you want to look at maybe do you want to look at like an online lender, like an On Deck or a Bluevine or a Cabbage? I don't generally recommend those because of the interest rate and fees that they charge and how they, the requirements that they have for you when you're repaying those loans. It could get pretty tough. So I don't usually recommend it. So, and then obviously maintaining liquidity and reducing existing liabilities. Those are always, you should be doing that anyway, but always good advice. So, okay. I'll tell you what, because I'm only going to run for about another 10 minutes here. Let's run through some other things here. I just want to, there was a couple articles I had here that were just kind of basic stuff. So Truist is ready to capitalize on fixed asset repricing, high return offerings. So Truist expects fixed asset pricing and high return business lines to fuel midterm goal of a return on tangible common equity in the mid-teens. After Truist sold its insurance business earlier this year, executives felt it was important to reset the company's return profile and set a medium-term goal of achieving a return on tangible common equity in the range of 15%. Chairman and CEO William Rogers Jr. said at a recent industry conference. The company's ROTCE increased to 13.8% during the third quarter from 10.4% in the previous quarter. I think we've got arguably the highest return opportunity in that medium term. There are some foundational things that we think can make the approach arguably reachable and achievable. So that's good for Truist. Hopefully they can pull that off. FDIC report makes recommendations to improve readiness for bank crises. This was a very interesting report that just came out from the Office of the Inspector General, and I'm actually going to be doing an episode on this. But in a nutshell, basically, it was a new report that came out from the Office of the Inspector General of the FDIC. They made 11 recommendations to address gaps in the regulator's readiness to resolve large regional bank failures. The recommendations came after the office assessed the readiness of the FDIC to resolve large regional bank failures and found that it was not sufficiently mature to facilitate a consistent response to a potential crisis. The report noted that at the time of the failures of Silicon Valley Bank, Signature Bank, and First Republic Bank in the spring of 2023, the FDIC had not ensured that it fully met human and technology resources needed to sufficiently coordinate resources among its divisions and offices. Yeah, the FDIC's got some work to do there. And like I said, I'm going to report more on that in another episode. So, Wells Fargo, no actual pickup in loan demand. So there has been little change in what has been a sluggish environment for lending post-election so far. Wells Fargo and Company President CEO Charles Schwab said December 11th, when you look at utilization rates, when you look at just new requests of loans, we have not seen an actual pickup in loan demand. The executive said at an industry conference, it is pretty consistent with what it's been. Client confidence does appear to have firmed. However, companies are waiting to see what happens with rates. They're waiting to see what actually happens post-election. We get questions about, do you see inventories building up because of potential tariffs and whatnot? We've not seen that in any meaningful way, although always looking for it. And it could show up tomorrow in the data, but we don't see it as of now. The sentiment echoes remarks from the executives of other banks at the same conference. So very interesting. So loan demand in the industry overall continues to remain sluggish. Then we have Citizens Financial says loan growth rebound will not be gangbusters. So Citizens Financial Group anticipates a modest pickup in loan demand in 2025 as receding fears of a recession are supported by the prospect of lower taxes and less regulation under the incoming Trump administration. The view is going to be more positive that we're likely to see not a gangbuster growth in 2025, but certainly we could take recession off the table. It's not going to turn on a dime. I think it's still not here yet. I'm not ready to say that yet. I'm not ready to say that recession is off the table. I'm just not ready to say that yet because of, look, all the things we've already covered already tonight. Especially the job, the labor market, the interest rate stuff, all the stuff we covered at the beginning of the live stream tonight there. Bank loan growth has been stuck in low gear for more than a year. Period end loans were about flat sequentially at Citizens Financial in the third quarter, with a modest core growth offset by contractions in a non-core portfolio of low-yielding auto and other consumer loans the bank is running off. Van Saun said he expects loan growth to be meaningful in the second half of 2025. That I don't necessarily disagree with. I think the back end of 2025 could be pretty good. I think that the beginning of 2025, it may be slow to kind of get out the gate, but by the end of next year, I think we could see some pickup and stuff. Now, why? Partially, why do I see because I do think interest rates will be a little bit lower than what they are now. That will help. But I do think that I did an episode a couple of weeks ago where I talked about the whole concept of extend and pretend and how banks have been following that for the last almost 2 years now. And that has created what they are now calling in the industry the maturity wall. This maturity wall, which basically all these banks are going to hit, starts in 2025, and it goes up for the next 3 years. It goes 25, 26, 27, and it does not peak until 2027. So you have a ton of debt, mostly commercial real estate, but a lot of other fixed debt out there that is is still coming up for renewal. And banks, I believe, have reached the point where they're going to say, you know what, we have to renew these loans. We can't put this off any longer. The rate is what it is. And they're going to have to put it out there, and the banks will have some delinquency. They will have some charge-offs. That is going to happen. But I think it'll definitely start to generate some more loan activity, and it will prompt things to kind of get moving again, most likely in the second half of next year. But we'll see. Okay, PNC CEO on bank acquisitions. The math doesn't work. Banks have just gotten more expensive since PNC Financial Services Group Chairman and CEO William Demchek's comments in October that he does not see much value in an acquisition. The math doesn't work. Demchek said in an industry conference, nobody is a seller, everybody is a buyer. A favorable interest rate environment and a healthy economy are delivering an industry-wide uplift, and banks are not feeling pressure to sell, Over time, however, you'll see a differentiation in earnings that will become pretty extreme, and that financial equation may change. Um, Historically, PNC has used acquisitions to acquire deposits to match its organic growth in commercial and industrial lending, Benchmark said. However, surveying the current landscape, many of these institutions have lost a lot of their core retail franchises, and their deposit base is heavily related to real estate and assets we don't want to own. Instead of acquisitions, PNC has been focused on building branches to enlarge its core funding lately. The CEO does expect few regulatory hurdles to M&A under the incoming Trump administration. However, he believes the environment for mergers of equals is tough. There has to be a clear acquirer as somebody who has the capacity to run the larger organization, both in terms of management expertise and technology and infrastructure and risk. That is going to be necessary to get approval, he said. So, yeah, so I think that's interesting comments there from the CEO at PNC. BOI, or I'm sorry, B of A, Bank of America. Net interest income is climbing up the ladder. So Bank of America is very confident in its projection for net interest income of $14.3 billion or more in the fourth quarter and a continued ascent in the subsequent periods. What you're seeing now is just quarterly progress up the ladder. Chairman and CEO Brian Moynihan said in an industry conference December 11th, man, doesn't it seem like everybody was at this conference? It seems like everybody was at this conference. That number will continue to go up. If you look at the deposit base, the asset yielding base of the company, and you go back and look at the last time we had a Fed funds rate above 3%, you can get pretty excited about the net interest margin trajectory. Moynihan said, with the outlook anchored by the bank's enormous pool of low-cost deposits. The CEO said the bank is also producing industry-beating loan growth, with an increase so far in the quarter that would annualize to more than 4%. Across domestically chartered banks, loans were up an annualized 2.5% from October 2nd to November 27th without seasonal adjustment and assuming no further growth for the rest of the quarter, according to the latest weekly data from the Federal Reserve. So, they're seeing some growth in their net interest income, which is good. They are seeing some good loan production. Kind of interesting. I'd be very curious as to what kind of loans they're doing at the moment and how they're doing it. But okay, FDIC problem bank list grows by 2, assets increased by 3.9 billion. So the FDIC reported that its problem bank list includes 68 banks as of the end of the third quarter, up from 66 banks a quarter earlier. In addition, the assets held by those problem banks spike at 3.9 billion to a total of 87.3 billion. According to data released by the FDIC on December 12th, those depository institutions comprise 1.5% of all banks, which is within the 1% to 2% range considered normal for non-crisis periods. This list includes banks with a 4 or 5 Camels composite ratings. Meanwhile, a number of insured institutions dropped by 21 during the third quarter to a total of 4,517. That net increase was due to a bank closure, 3 sales to credit unions, 18 mergers with other banks, and 1 bank opening. And let me see, do I have one more? And this is, U.S. investor risk appetite climbs to 2024 peak in December. So bullishness among U.S. investors continues to climb in December after the outcome of the U.S. presidential election caused positive investor sentiment to swell in November. According to the latest results from the monthly S&P Global Manager Index survey, released December 10th, the survey's risk appetite index saw a lift of 2 percentage points from last month's results to reach 41%, marking the most positive result of the year and the highest reading since April of 2021. The index measures net risk tolerance among surveyed investors. So we can see here on the chart, there's a nice spike up, which is very good. And there you have it. So, okay, everybody. So that's what I got for you guys tonight. I thank everybody for tuning in and sticking with me here. I always appreciate it. So we got a lot of stuff going on, in the banking world, as it were, right now. Just a number of stories that I continue to follow here on the channel. Lot of, as we talked about earlier, a lot of economic data coming out this week, and I will be back next week to cover all of that for everybody. So I'm just going to wrap up by saying, if you like this tonight, Please make sure to like, share, and subscribe, as that always helps the channel. I'm trying to make this run, trying to get up to 1,000 subscribers. So if everybody is liking what they're seeing, please spread the good word. That's all I ask, is please spread that good word on the channel. That always helps. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please leave your comments down below, as I always love getting back to everybody. Make sure to check out some of the other content on the channel. I have a number of series out there, whether it's the Lord of Easy Money, a bunch of the interviews that I've done, the crypto series. I have a bunch of stuff out there for everybody. I have a lot of great stuff that's going to be coming up here over the next couple of weeks. So please stay tuned. I hope everybody has an awesome and safe weekend out there. And I will be back next week to see you again here. We'll be back in the strategy room next week. I hope to have everybody here with me. And like I said, see everybody again real soon. Thanks.